Good day and welcome to the Emmvee Photovoltaic Power Limited Q1 FY27 conference call hosted by Radhi Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that anything said on this call that reflects the outlook towards the future, which can be construed as a forward-looking statement, must be reviewed in conjunction with the risks that the company faces. A copy of the disclosure is available on the investor relations section on the website as well as on the stock exchanges. Kindly also note that the audio of the earnings call is a corporate material of Emmvee Limited and cannot be copied, rebroadcasted or attributed in the PR media without specific and written consent of the company. To give you an in-depth understanding of the company and answer all your queries, we have from the management side today Mr. Manjunatha DV, Chairman and Managing Director, Mr. Suhas Tonti Manjunatha, President and CEO, and Mr. Pawan Kumar Jain, Chief Financial Officer. I now hand the conference over to Mr. Manjunatha, sir. Thank you, and over to you, sir.
Thank you. Good evening, ladies and gentlemen. A warm welcome to all our shareholders, investors, analysts, and colleagues joining us today for Emmvee Q1 Financial Year 27 earnings call. Thank you for your continued trust and confidence in Emmvee. Financial Year 27 has begun on a strong note for our company. During the quarter, we delivered revenue from operations of 1,555 crores, EBITDA of 548 crores, and profit after tax is 380 crores. With an EBITDA margin of 35%, our order book further strengthened to 9.9 gigawatts, supported by fresh order inflows and approximately 1.5 gigawatts. More importantly, these results reflect the strength of our business fundamentals. They were driven by improved operational excellence, execution, higher manufacturing efficiencies, stronger integration benefits, disciplined cost management, and continued customer confidence. Operationally, this was our best quarter so far. We achieved record production across both solar module and solar cells, with higher cell utilization further strengthening the advantages of our integrated manufacturing platform. This quarter also marked another foundation day for Emmvee. Looking back over more than 3 decades, we have grown from small solar water heater manufacturing into one of the leading Indian integrated solar manufacturing companies. While our scale has changed significantly, our values remain the same: quality, innovation, customer trust, integrity, and long-term thinking. I sincerely thank our employees, customers, suppliers, lenders, shareholders, and all our stakeholders for their continued support and confidence in our journey. Looking ahead, we believe India is entering a defining decade for renewable energy. Growing electricity demand, increasing energy security, domestic manufacturing initiative, electric mobility, energy storage, green hydrogen, and data centers are creating a significant long-term opportunity for the Indian solar industry. The implementation of ALMM List 2 is another important milestone in strengthening Indian domestic manufacturing ecosystem. Emmvee entered this transition from position of preparedness. Our operational TOPCon cell manufacturing facility and inclusion under ALMM List 2 position as well to benefit from the growing demand for domestically manufacturing solar cells. At Emmvee, we firmly believe that long-term leadership will not be determined simply by installing capacity. It will be determined by technology, operational excellence, supply chain resilience, financial discipline, and consistent execution. Our ongoing 6 gigawatt integrated TOPCon cell and module expansion continue to progress according to plan. Upon completion, our installed capacity will increase to approximately 16.3 gigawatt of modules and 8.9 gigawatt of solar cells, significantly strengthen our integrated manufacturing platform. At the same time, we continue to prepare for the next phase of backward integration into ingot and wafer manufacturing Together with our investment in digital technology, automation, and artificial intelligence, these initiatives will further strengthen our competitiveness and support sustainable long-term growth. As we move through financial year 27, our priority remains clear: execute our expansion on schedule, increase utilization across our existing facility, strengthen technology leadership, maintain financial discipline, uphold the highest standard of governance, and continue creating sustainable long-term value for all our stakeholders. Ladies and gentlemen, the India solar manufacturing industry is on an important inflection point. The companies that will lead this industry will be those that combine technology, integration, operational excellence, customer trust, and disciplined execution. At Emmvee, we remain committed to building exactly the kind of institution. We have started financial year 27 with a strong momentum, and we remain confident about the opportunity ahead. Thank you once again for your continued trust and support. I will now invite our President and CEO, Mr. Suhas Donti, to take you through the operational and financial performance for the quarter in greater detail. Thank you.
Thank you, Mr. Manjunatha, for your opening remarks, and good afternoon to everyone joining the earnings call for the first quarter of FY 2027. We have started the financial year on a strong note with healthy growth in revenue and profitability, record quarterly production, improving capacity utilization, and continued momentum in our order book. Let me begin with the financial performance. Revenue from operations for Q1 FY 2027 stood at 1,555 crores, registering growth of 51% over Q1 FY 26. EBITDA for the quarter stood at 548.1 crores, an increase of 56% year-on-year. EBITDA margin improved to 35% compared to 34% in Q1 FY 26 and 33% in Q4 FY 26. Despite the sequential decline in revenue, EBITDA was lower by only 4% quarter-on-quarter, reflecting operating leverage, optimizing of expenses, and benefits of increased internal cell consumption. Profit after tax stood at 380.3 crores, registering growth of 103% over Q1 FY 26. PAT margin improved to 24% compared to 18% in the corresponding quarter last year and 23% in the previous quarter due to lower finance costs that reduced significantly to 11.1 crores compared to 53.1 crores in Q1 FY 26. Moving to our operational performance, both module and cell production reached their highest ever quarterly levels. Solar module production stood at 970 megawatt compared to 635 megawatt in Q1 FY 26 and 952 megawatt in Q4 FY 26. This represents year-on-year growth of 53%. Solar cell production increased to 454 megawatt compared to 360 megawatt in Q1 FY 26 and 428 megawatt in Q4 FY 26, representing year-on-year growth of 26%. Effective module capacity utilization stood at 45% compared to 44% in both Q1 FY 26 and Q4 FY 26. Cell capacity utilization improved further to 83% compared to 68% in Q1 FY 26 and 79% in Q4 FY 26. The continued improvement in cell utilization is an important operational milestone. It increases the proportion of internal manufactured cells used in our modules, strengthens our integrated manufacturing model, and supports better control over product quality, supply availability, and margins. Our current installed capacity stands at 10.3 gigawatt of solar modules and 2.94 gigawatt of TOPCon cells. Our inflow during Q1 FY27 stood at 1,484 megawatt. Consecutively, our order book increased to 9.9 gigawatt, of the end of the quarter, compared to 9.4 gigawatt at the end of FY26. The order book provides healthy revenue visibility and reflects continued demand across utility scale, commercial and industrial, and rooftop solar segments. Let me now provide you an update on our ongoing capacity expansion. Work on the 6 gigawatt integrated TOPCon cell and manufacturing facility is progressing in line with our plans. The module line is expected to be commissioned by December 2026, followed by the cell line by March 2027. Commercial sales will commence in line with the respective commissioning schedules, with capacity utilization expected to scale progressively. The total project cost is estimated at approximately 5,500 crore, including hard costs of around 4,600 crores. Debt funding of approximately 3,300 crores has been tied up at the cost of less than 8%. All major equipment has been ordered. Orders representing approximately 60% of the total hard costs have been already in place. Following the completion of this expansion, our total manufacturing capacity is expected to increase to approximately 16.3 gigawatt of modules and 8.9 gigawatt of cells by end of FY27. The implementation of ALMM List 2 from June 2026 is another important development for the domestic industry. The requirement for the use of domestically manufactured cells in covered projects is expected to expand the addressable DCR market beyond the government schemes. We expect DCR demand to strengthen progressively during FY27 as grandfathered non-DCR projects are completed and procurement aligned with the ALMM requirements becomes more broad-based. Domestic supply of high-efficiency TOPCon cells continues to remain relatively tight, which should support the operating environment for established and compliant cell manufacturers. Our existing cell manufacturing capacity, improving cell utilization, plant integration, integrated expansion position as well to participate in this opportunity. We have also outlined our medium-term plan to further backward integrate into ingot and wafer manufacturing. The proposed facility will have a total of 9 gigawatt and is planned in two phases, with 5 gigawatt targeted in FY29 and the remaining 4 gigawatt in FY2030. The timings of this investment will remain subject to the final clarity on ALMM List 3 and prevailing market conditions. The capital expenditure for the same is expected to be funded largely through internal accruals. This backward integration is intended primarily to protect margins, reduce exposure to upstream supply chain volatility, and strengthen the economics of our domestic cells and module manufacturing operations. To conclude, Q1 FY27 represents a healthy start to the year. We delivered strong year-on-year financial growth, expanded margins, achieved record module and cell production, improved cell utilization, and strong additions to our order book. Our priorities remain focused on increasing utilization of existing capacity, executing the order book efficiently, commissioning the 6 gigawatt integrated facility according to schedule, and maintaining financial discipline as we progress through the next phase of growth. I would like to thank our employees, customers, suppliers, lenders, shareholders, and other stakeholders for their continued support. With that, we can open the floor for questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask questions may please press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and one to ask questions. The first question is from the line of Rohit from Axis Max Life. Please go ahead.
Thank you for this opportunity. First of all, congratulations on a very strong set of results. My question is more to do with the EBITDA per watt in DCR and non-DCR modules that you do right now. How has it fared in this particular quarter? What is the trend like, and what is the outlook over there?
Yeah, I think, thank you for the question, Rohit. And I think EBITDA in both non-DCR and DCR have been in line with what we experienced in the previous quarter, which is also reflecting from our EBITDA margin as well. And so far, going forward, also what we are expecting is a stable kind of a scenario, and that is what is reflected as of now.
Okay. My second question is more to do with the capacity expansion plans, like 6 gigawatt integrated cell plus module, where you have stated that the module plant will be operational by Q3, and you want to expedite even the cell plant before the beginning of FY28. So when will the order booking start, and what should be the quantum jump in order backlog or order inflow one should look? Will that be a right indicator to say that the things are getting commissioned on track?
See, order backlog is something that we've already started seeing expansion of, and that is in tandem to our increasing growth as well. Today we have an order inflow for close to 1,500 megawatt and order book of close to 10 gigawatt. So with that, we are looking at almost more than close to 7 plus gigawatt of orders that to be executed in the next 18 months. So that is quite in line with our expansion plans as well. So yeah, I think we are already started to see that.
Okay. And my final question is more to do with the wafer ingot backward integration. This you have stated that the rollout will be in 2 phases. Is the board approval done, and will we hit the ground immediately, or are we waiting for some sort of a procedural steps ahead?
No, there's no procedural steps. Rather, like the timing that we have planned the commissioning is by mid of calendar year 28. So that does not require such early actions to our understanding. So that is something that in line we are planning. Because it's quite clear that our priority right now is expanding the cell and module, and ingot and wafer is something that we are adding in calendar year of 28. So we will take the actions accordingly.
Thank you. I will get back into you. Thank you. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Subramaniam Yadav from SBI Life. Please go ahead.
Thank you, sir, for the opportunity. Sir, if you can give us a trend or the number in terms of gross margin spread, because we have the production number, and if you can give us gross margin spread on the sales number, that would be helpful.
Thank you for your question, Subramaniam. So I think we've been guiding more or less on the EBITDA spread rather than the gross margin spread. So probably for the sake of clarity and understanding the trend, we'll stick to the EBITDA per watt. And EBITDA per watt, what we had guided is around 2.5 rupees per watt for this module, and for the cell part of it of 6.5 rupees per watt. So I think that is something that's in line to the current trends also.
Did move from Q4 to Q1?
Not much. I mean, it's in the similar stage. It's a similar state. If you see that similar.
Okay. Okay. And also, sir, on the overall mix of DCR and non-DCR, how was it in terms of sales?
This time the DCR, non-DCR mix have been healthier on the DCR side, which is which is the output of our increased margin percentage as well. We have done, I think, over 50% DCR mix.
Okay. And sir, how is it likely to be ahead in next couple of quarters?
So looking at our module to cell capacity, difference and the market scenarios, there will be more module, more non-DCR than DCR, but it's not going to be as dramatic as the capacity will look like, because we have some comfortable DCR inventories that we intend to use in these coming quarters.
Okay. Thank you, sir. Yeah.
Thank you. We'll take the next question from the line of Prakhar Podwal from Ambit Capital. Please go ahead.
Thank you for the opportunity. So just one question. After 1st June, how has been the C&I demand in terms of order inflows? And also I understand you have mentioned that from Q4 to Q1, the margins have been stable, but in terms of new orders, which maybe you'll execute in next 6 months or 12 months, are you seeing margins increasing again because of some tightness on the solar cell side currently? That is the question.
Thank you, Prakhar, for your questions. On the C&I demand order inflows, that's something that we've already started seeing. But the supply of it is something that you should expect towards later of this financial year and not immediately. But this is the movement that we have already started seeing in our order inflows. And when it comes to the margins, that is there. We've been in a similar state of margin per watt peak, like I said, both in DCR as well as non-DCR cells in the Q1. And what we are seeing also is yes, there could be there could be some slight improvements in the DCR side, but I think it's not something to consider. Rather, just assuming the stable levels of margin more confidently is something that you should take back from this.
Sure. Just a follow-up on that, because I was hearing some news about C&I players, specifically in Karnataka, requesting the state to push back the deadlines given current unavailability of DCR modules. So anything, given you're based in Karnataka, anything on that also? Or is the availability in terms of DCR modules totally there and those are just rumors? Anything on that?
Yeah, it's important to recognize that the ALMM implementation in reality is coming in a phased manner. And I think companies like Emmvee are equipping ourselves in that kind of phased manner to be there at the forefront of the industry with the expertise that we have for the last 2 years of TOPCon cell manufacturing capability to deliver the requirements for the requirements for the demand. And I think the government is very clear. In fact, their intentions and discussions have now started. We are all looking at the ALMM 3 rather than looking at ALMM 2 anymore. So I think this is something that's already happened, and now we need to focus on how do we bring in the ingot and wafer and ensure that is going to be done.
Sure. And on the current capacity of 2.9 gigawatt, can you expect more run rate increase going forward? So let's say 450 going to 500, 550, that kind of number? Because I understand the capacity is at 11 watt peak, 710 watt peak modules. So just that before the new capacity comes in, can we see more increase in the run rate production?
Yeah, absolutely. That is something that you should expect to see in these coming quarters.
Okay, sure. Thank you.
Thank you. We'll take the next question from the line of Apurva Bahadur from IIFL Capital. Please go ahead.
Thank you, Suhasi, and congratulations on another strong quarter. I just wanted to check in our sales mix, have we also sold cells, or have we restricted ourselves to selling DCR and non-DCR modules?
Yeah, thank you, Apurvaji. Yeah, our sales mix also includes merchant sales.
Okay, and is that a meaningful number or is it very small?
It is an increased number quarter-on-quarter, or this thing probably the highest we have also done in the history of Emmvee also. So I wouldn't say that it's a dominant number, but it's a meaningful number.
Okay, understood. Secondly, I when I see the financials, I see a sharp quarter-on-quarter drop in the cost of raw materials consumed, about 18-19% Q-on-Q, while the production has increased slightly. What is leading to this sharp decline in cost of raw materials?
Yeah. So see, there are a couple of things. I think maybe I'll let Pawanji add in. But here the couple of things are that the mix of DCR and non-DCR, when it becomes healthy on the DCR side, you will see the COGS being much more better. And two, like I said, there is also cell sales that is involved in this quarter. So that is also a reason why you should see the absolute COGS also being lower compared to the previous quarter.
Okay. So is this trend sort of expected to continue in future quarters as DCR sales pick up even further, or do you expect this to be sort of a one-off thing?
No, this purely depends on the mix of the DCR, not DCR, and also the cells. So I think accordingly it accordingly it will change. So that should not be any guidance that should be taken out of that.
Okay. Understood.
But the understanding is that if the mix were to be same, then yes, it will be similar. I don't see a change in that.
Okay. And in last quarter, I recollect there we had a discussion about the inventory position. And so how is it at the end of this quarter? Are we seeing a wind down of inventory, or it's still at similar levels?
Yeah. So inventory, if you see in the P&L, there's some change in inventory, which is mostly finished good because the production is high. So some inventory has been added some production is added to inventory. But otherwise, bearing this 74.5 crore of the addition to inventory, otherwise it is in line with our previous quarter's inventory levels.
Okay. And are we expecting, sir, this inventory to wind down in future quarters, next 1 or 2 quarters, or do we expect to carry this type of finished goods inventory into FY27?
With the order book, healthy order book, and we added another 1.48 gigawatt order book. So this will help us to, liquidate the inventory also, both in terms of finished goods and raw material also. Inventory will be used to have a improved production to meet the target orders.
And added to that, this quarter we have strategically kept little more raw material, and the materials reason is of the geopolitical issues what is taking place.
Okay. Understood, sir. And sir, lastly, I think on the availability of silver, I think government had imposed some sort of restriction on import of silver. Are we facing any challenges because of that, either in terms of securing the raw materials or in terms of the pricing in India?
This is a good question. So we are not facing any difficulties. It is only procedural has been introduced. So what we have to do is now we have to apply well in advance to the DGSND for what is the import quantity we are want to bring it. Then accordingly they are giving approval to the import. So what Emmvee is following up is we are following up three months inventory what we required. We are applying in one time, and we are getting into the approvals in time. And last by the time of introduction to till date, we have not faced any difficulties. As soon as we are applying, within 3 to 4 days, we are getting the approvals.
Okay. And sir, is the pricing in line with the global price, or is there a premium in India and the retail or the spot market?
No, we still it is in imported only, so it is in line with the earlier prices. There is no changes because silver paste still we have largely depend upon imported.
Understood, sir. Thank you so much. I'll get back in the queue.
Thank you. The next question is from the line of Sahil Jinesh Seth from Anand Rathi Institutional Equities. Please go ahead.
Hi, sir. Thank you for the opportunity. So, sir, just following on a previous question, you said the finished goods inventory was increased in this quarter. But if I were to look at the DCR number from the DCR portal, the module manufacturing and sales data is quite in line. So would it be fair to assume that the slower offtake is only in the non-DCR segment and not as much as in the DCR module segment?
No, this is not the offtake. This is the order. The non-DCR normally we produce based on the orders or the offtake. It is only. It is all done. The pickup of this particular quarter is not been done in the last month because of LC establishment and other things, which is the movement is happening in this month.
This is as per the normal cascading that would be expected.
Because of some rains in those areas, they are not able to pick up the materials.
Okay, sir. And so my second question would be, when you previously mentioned that the 50% mix was DCR, does that only includes DCR modules or it also includes your DCR cells in that mix?
That's both included. That's both included.
Including both. That was helpful. Thank you, sir.
Thank you. The next question is from the line of Karan from Niveshaay. Please go ahead.
Yeah, thank you for the opportunity. Wanted to understand, like, we have a 50% mix in revenue for DCR. So, is it similar in our order book as well?
Order book is increase. There has been more and more increasing DCR in the mix of order book. Yeah, I mean, but there is still a good non-DCR portion as well that is there. But yeah, it will be around the similar.
Understood. And what would be our blended realization for modules currently?
Realization for module in the last quarter was, I think, around 15 cents, 16 cents in the non-DCR.
Has it increased for us because we sold more DCR modules this quarter?
Yeah, there is a small increase about on a blended one. It is going to be about 1 rupee increase is there.
Understood. And one last question, like, what would be our peak utilization that we can achieve in modules and cells, and when are we expected to achieve for the current facility?
So peak utilization for cell is around 85 to 90%, which we are already close to that. And with respect to modules, it will be about 65%. But with cell, as we are transitioning to G12R, the overall effective capacity is also going to increase. So you will see a higher production volume, even though the percentage could remain similar.
So our transition has been completed, or is it still in process?
Already.
We have started this thing. We have already, we have partially completed the conversion. So then, but then the remaining is, we will convert it sequentially.
Understood. Great. Thank you so much, and all the very best.
Thank you.
Thank you. The next question is from the line of Meghna from Old Bridge Capital. Please go ahead.
Just to follow up to the original question, what in the coming quarters, what is the module utilization that we expect? And when do we?
I think you can take it at on a base case at similar levels. I think that will be a fair assumption to take it.
Okay, got you. And any color on when do we expect to achieve the 65% level?
I mean, we expect that, we'll keep increasing the production volumes. Rather, like, instead of guiding on that, what we are stuck to guiding is strictly on the EBITDA, overall EBITDA, absolute EBITDA perspective. And, we're looking at around 2,400 crores of EBITDA, closing this FY27. So we should be reaching increasing levels of utilization on modules and cells as well.
Got you. Thank you.
Thank you. The next question is from the line of Karan Gupta from Asit C. Mehta Investments. Please go ahead.
Yeah, hi. So my question is on the capacity utilization of cell. As you look at the previous quarter's numbers, a couple of quarters, the cell capacity utilization is improved significantly from 50% to 83% if you compare quarter 4 FY25, and your EBITDA per watt is more or less the similar in line. So my question is on, we are not getting the backward integration benefit plus the utilization benefit in our EBITDA per watt numbers.
No, you are getting it. On per watt number, you will not get, because it's, again, if your utilization is going up per watt, your production is going up, but mainly it's the ramp up of efficiency and the raw material that's happened. But also absolutely, you can see that our module production has also gone up. So on blended basis, it will be difficult to measure that way.
If you calculate cell to module ratio, which is, if I assume, let's say your cells, 100% cells are going into your modules, right? Whatever the cell number you have produced, 100% is going to the module side. So which is in line, 45 to 46% historically in a couple of quarters. So this is the number same, but as the capacity utilization is increasing, so the benefit of backward integration plus the benefit of your capacity utilization, which is operating leverage, should come into the EBITDA per watt numbers. What's your view on that?
You can see the other operational improvements in these on these lines.
So one more thing, if you see the previous quarter, if Q4 the EBITDA margin is around 32.84, and this quarter is 35.2. So this is also because of the mix, and we are getting benefit of a domestic sale produced. So that is also getting reflected in the EBITDA margin.
Okay. What's the number of cell you are selling to outside or to the merchant? And what is the in-house?
We are not disclosing the sales mix of our cells, modules, and DCR and non-DCR. Rather, there has been a significant increase in cell sales this quarter. So the understanding that all the cells that we make are going into our modules is not correct. Rather, there is a big mix of both. We are selling separately as well as we are using in our own modules. So that is why it will be difficult for you to look at it on a EBITDA per watt on a blended basis. Rather, it is something that you should, it is something that there has been that reflection in the financials.
Okay, so in cell capacity, we are seeing the operating leverage part when we are selling outside. EBITDA per watt standalone basis for the cell capacity. So we are seeing the operating leverage part playing out in the cell part.
What was the question?
So for the standalone cell capacity utilization, as it is increasing. So for EBITDA per watt, if you just calculate for the cell portion, the operating leverage playing out when you are selling into the outside market and consuming inside.
No, see, it's not that this thing. We have to also be significantly, aware that the changes in the raw material prices, either the silver or with respect to, the other kind of increase in raw materials are not reflected where the EBITDA per watt peak is going down. And this is happening only because increased operating leverage. Because our consumptions have been more streamlined, our operating efficiencies have become better, efficiency of the cell has become better, and the consumption has become better. So that is why you are able to see this, stable EBITDA per watt irrespective of the increase in other headwinds that we are seeing.
Okay. So for cell, we are getting better realization in the outside market?
No, realization for cells has been quite stable. So has been modules, so has been DCR and otherwise. So realizations have been quite stable. It's in line with the movements in your commodities.
So could you please put the number?
Mr. Gupta, I'm sorry to interrupt you. Sir, I would request you to kindly rejoin the queue for follow-ups. We have a queue here, sir. There are others who are waiting for their turn.
Sure.
Thank you so much, sir. We'll take the next question from the line of Dhruv Muchal from HDFC AMC. Please go ahead.
Yes, sir. Thank you so much. So firstly, on the non-DCR modules now, non-DCR cell-based modules now, what at least the news flows are suggesting that the market has become more limited now because the market, CNI, at least the CNI market has shifted to the DCR cells now, and also rooftop anyways was. And probably there could be some margin compression in the pure module business. But based on your guidance, it seems that's not the case. So just trying to understand, the guidance that you're giving 2.5 rupees on modules, EBITDA, is that the blend of DCR modules plus non-DCR modules, or just the DCR just the non-DCR modules?
No, there has been, sir, just for clarity, I think there are markets operating at different places, but it's important to recognize that there is only limited supply that has been always available for with players who have the bankability and credibility of supplying to the the IPPs and the IPPs of both C&I and developers. And today, whoever has the grandfather projects are the very very serious IPP players. So there, what happens is the operating leverage of these. Here, what happens is that the selectiveness of quality, stability, and bankability becomes extremely crucial. So at that point, players like Emmvee are at the forefront of that, where there is no pressure to operate at every levels. So for us, it's very clear that choosing our markets, choosing our customers in terms of without letting go of the bottom line is something that's been very important to us. So making that reasonable return even with lower utilization is rather better than making the higher utilization and lower margin. So that's the philosophy we've been following.
Got it. So, but purely on modules, based on your level of volumes that you expect, basically, I don't know, I think 50 or 60% utilization on the capacity of module, you believe, despite the change in the market structure, but because of your positioning, you will be able to get to that 2.5 rupee EBITDA?
Yeah. That should be in that range, yes, absolutely.
Sure. And so secondly, just to reconfirm, the cell pricing, for example, the cells that you sell, they are based on dollar pricing. They're not based on INR pricing, right?
Yeah, correct.
Say, for example, whatever sells to the rooftop market or the Kusum market, whatever, or CNI market, that all happens in the dollar pricing based.
Correct.
So any, the dollar change, which probably has some implication on your input pricing, but to a large degree gets offsetted because the selling price is also in dollars.
Yeah, that's correct.
Sure. Okay, sir. Great. Thank you so much, and all the best. Thank you.
Thank you. The next question will be the last question for today from the line of Dhaval Popat from Choice International Limited. Please go ahead.
Yeah, thank you so much for the opportunity. My question is, this is regarding particularly passing of the raw material costs. You did say that it moves in line with the commodity. So is it fair to understand that you are still able to pass on the raw material or at least certain part of the raw material costs to the customers? Like, for example, as silver fluctuated so much, were you able to pass on these costs, or how should we read this? If you can throw some light on this, if possible.
Yeah. This we have answered even in the last time also. See, we do two types of the pass-through will be done in two ways. One is we will do value engineering in the production. If that is there, we will not pass through to the vendor if we can able to make it in line with our margins. If not, yes. That's why if you see the change in the prices will be there. That's why we always say absolute number of EBITDA will consider, not on the percentage. Percentage may vary because if my price is high, the percentage will come down. If the price is low, my percentage will go up. But my absolute number will remain same.
Okay. Yeah, that is helpful. And I'm sorry if I missed this, but there was. Should we expect that given the prices decline, could we expect recurring inventory losses, or that would not be the case, or how do you plan to protect against this inventory losses particularly?
There is no decline in the prices. That what we said is non-DCR we normally produce based on the orders inflows only, and which is already covered by the advances and the LCs. So which doesn't have any effect. And DCR market, you know that there is not going to be any change as of today. So as of now, we have not impacted anything on the price variations because we are strategically, even if you see in the earlier 3-quarter calls also we made very clear, we normally inventory and the dollar as well as the procurement of material based on our the inflows of orders.
Mm-hmm. Yeah, okay. Thank you so much. I hope we can connect offline as well because we are looking at this company. Yeah. Thanks for the opportunity. I'll connect offline.
Thank you. Ladies and gentlemen, we'll be taking one more question for today from Gaurav Birmiwal from Axis Mutual Fund. Please go ahead.
Thank you, sir, for the opportunity. I just had one question. So you did elaborate on how the margins are split, but just for my understanding, let's say if you produce and sell itself separately, how much margins will you make there? Let's say second case, which is you produce the cell, you convert it to modules as well. How much are the margins there? And third is, of course, the non-DCR, wherein you buy cells from, let's say, China, and then you convert it to modules and sell it. So what will be the margins in each of these three cases?
Yeah, thank you, sir, for the question. So, like we said, non-DCR module is about 2.5 rupees per watt, and then the cell is about 6.5 rupees per watt. So DCR module is usually 8.5 to 9 rupees per watt. So that's pretty much like, you either sell separately or you sell together. It's pretty much similar kind of margins.
Understood, sir. Very clear. Thank you.
Thank you. That was the last question for today. Thank you, members of the management. Thank you once again for your time and participation. On behalf of Emmvee Photovoltaic Power Limited, this concludes today's conference. For any questions, please feel free to write on the email IDs mentioned on the invite. We appreciate your engagement. You may disconnect your lines now. Thank you so much, sir.